All right, I think it's 3 o'clock, so we'll get started. So, agenda for this meeting is mostly on the trades that we have shared on our Telegram channel. So, it's like an open forum where you can ask any questions that you have, and we'll try to answer those. But before we take the questions, there is one thing which I and Shubham wanted to address regarding the trades that we are sharing. We realize that there are a lot of open trades, and if someone has a smaller account size, let's say 20 lakh, 25 lakhs, so for those account size it is not possible to take all the trades which we have shared. Its simple reason is because we trade based on exposure and not based on margin required. So when we suggest a trade, we also give the required account size and the required margin with which you should trade you should take that particular trade. So given that we have been sharing most of our trades which we are taking, so we realize that the number of trades that we have shared is on the higher side. So what we suggest is that those who have smaller account sizes, 15 lakh, 20 lakh, 25 lakh, they should still stick to two times the exposure. And this two times the exposure is for the trades which are naked options. So any strangle that we suggest or any straddle that we suggest, and we are recommending those trade to, let's say, sell a strangle or sell a straddle, then considering that exposure for that particular trade, it should not go beyond 2x. So let's say if you have a 20 lakh account, so your total exposure should be 40 lakhs on the trades which are naked. So if we have shared a Bharti strangle cell, Bharti's exposure is around 12 lakhs. So that should be taken with 6 lakh margin. So out of the 40 lakhs, 6 lakh is utilized for Bharti. So this way you can take strangle or straddle until a point you utilize that 40 lakh margin. Shubham, you wanted to say something?
Yeah, Ashish. So basically, for 20 lakh account or a 50 lakh account, the portfolio has to comprise a diversified mix of strategies. So when Ashish and me are suggesting trades on a Telegram group, we've been suggesting a wide variety of trades, right? So try to ensure that even when you're trading with a smaller account, you take on, I think a maximum of four naked strategies, be it straddles and strangles, maybe one or two iron flies or iron condors, and two to three risk defined trades. Even if you take the notional value of all these trades into consideration, including the risk defined ones, I think the leverage would be around 2 to 3x, which I think is fine. Including the risk defined trades, the exposure should be fine, and I think the margin utilized should be around 55 to 60% of what we're suggesting right now. And we're also obviously working on a system where we can maybe create a group for a sample trading capital. That would be much easier. Right now, since we are both trading with a higher level of capital, so it becomes difficult for us to filter out what trades to share and what not to. In fact, we have been taking a couple of trades without sharing, simply because we also obviously come to the realization that the number of trades are too large for a small account. So we're working on it. But for now, I would ask you guys to, at least for a week or so, to filter out the trades based on the criteria that has been given.
Right. We are not sharing any trades which, I mean, most of the trades which we are taking, we are sharing, but some of the trades which are, in metal stocks, large underlyings like Nalco or Vedanta. Vedanta, I think we did share one trade, if I'm not sure.
Yeah,
Uh, so, so yeah, we are trying to avoid those trades not to be shared on Telegram channel. But yeah, if you have a smaller account size, you need to filter that out. And uh, that one thing which you always have to ensure is that your exposure should not go beyond two and a half times your account size. So if you are getting a trade and you are already full, it's best that you avoid that trade instead of taking that one. Okay, and like Shubham said, that we are working once the number of open trades go down, we will work out something so that we create a sample account size, say 25 lakhs, and for that only we share the required number of trades so that it is easier, and you can also see how we are sizing our position for a 25 lakh account. Yeah, that is one thing which we wanted to cover from our end. I think we'll go ahead and take questions. So Shubham had received one question in DM, I think. So Shubham will take that question first, and then I'll start approving the request, and you guys can ask questions.
Yeah, right. So Ankit had asked regarding wall short ideation, and he also specifically mentioned that there are certain stocks which would be having earnings next month. So how do you ideate and how do you deal with the stocks? So when it comes to earnings, we don't recommend taking any trades on stocks, especially undefined risk trades on stocks which have earnings in 20 to 25 days. Now, as to trade ideation, I think the best thing to do when you're starting out is create a watch list of about 30 stocks, form a view, and according to the view, check the IVs. So if the IVP is high, that's my default metric. The IVP is high, I would prefer to put on a neutral trade rather than a directional trade. And even when the IVP is high, there's a certain metric that you can check. It's the variance premium, which is basically the implied volatility minus the realized volatility. You can get that on Opstra. It really helps to you know uh, help you take a judgment call on whether that stock is suitable for a neutral trade or not. When it comes to directional trades, I will not speak about which stocks we choose for a directional basis. But let's say, for instance, if you want to take a contrarian trade, I think ratio spreads are really good to take contrarian trades on stocks which are at support or resistance levels. For breakout trades, I prefer defined risk trades because generally the IVs are low prior to the breakout, and that would help take defined risk trades. And I think Ashish has covered most of the basics for wall shot ideation in his video, so that would be great. But I think my suggestion would be to start by having a watch list and building a portfolio based on that. So if you take a couple of neutral trades initially, maybe then try to go with a couple of directional risk defined trades to sort of build a wall shot portfolio.
All right. Let's start taking questions now. Anand, you can go first.
Uh, um, uh, uh, Actually, I didn't have many questions at the start, but I wanted to understand from you which are the suitable softwares for ranking of these IVs.
So both of us are using Opstra only, and we have tried Quantep. Options Oracle is something which Shubham uses to record his trades, but mostly it's based on Opstra that we take the trades.
So, if someone just takes uh, a guess on the increasing IV, looking at the charts only and not using these softwares. So, in that case, if a similar strategy as you are using is used, so how much will be, or what kind of disadvantage it will be if not using a professional software but just making a guess on that. Okay, for example, the other day in January, when SBI opened up 10% up, that so surely,
Right.
yeah. So just looking at the charts, if someone does exactly what you're doing but without using the software, what will be the disadvantage, or will it be viable at all or not?
All right. I think I said this in one of the videos which I did, that even if someone doesn't have much understanding of volatility, and if they are not forecasting the future volatility that well, even then if they take the position size thing very seriously and trade under leveraged, then chances of at least making huge losses is less. I would say that way. But obviously, when you trade based on IV and based on IVP, and how is your perceived forecast of the volatility, then obviously the win rate increases, and chances of making money increases.
Yeah, but
Uh,
without using the software, will it be viable at a portfolio basis, not trade by trade basis, at a portfolio basis? Because I believe that realized vols in stocks most of the time is lesser than the implied. So will it be viable at a portfolio basis?
Yeah, Anand, hi. So I do not feel that it's very much viable on a portfolio basis. So two things on this. So basically, stock volatilities are very difficult to equate as compared to industry volatilities. 90% IVP in say Nestle would might imply a straddle premium of 5%, whereas a 10% IVP in Adani Enterprises might be a 10% premium in straddle prices. So for that, you kind of need a software so that it helps you see things with an open mind. And you're right regarding gaps. Generally, when there are gaps, you would notice an IV spike, and that is very easy to see. But on a day by day basis, there might be stocks where the realized volatilities have actually stayed very low, with IVs expanding to a level which where the variance premium might be very good to take on a short trade. So for those kind of trades, you do need a software, which I feel. And if you're taking multiple stock option trades, it definitely makes sense to have some sort of software at hand. Yeah.
Uh, Secondly, I just wanted to say it one more time. I or Shubham do not have any association with Opstra. It's just that it gets promoted because of we use it, and then it is not very expensive. Also, I think it is about 8,000 or 9,000 for 6 months or so. So someone with a capital someone with a capital of say 20 lakhs also, it's not that expensive to buy premium subscription of Opstra.
And Quantsap is another alternative, but I find the Opstra interface far easier to use than Quantsap. It's just a personal preference. I mean, I'm sure
Uh,
Quantsap
uh,
users might argue that they have might be more accurate for
I
me.
have used
Could
a
be.
concept a little bit. I was not very happy with the data that was being. I mean, but maybe that's just me.
Right.
No, I think data is from data point of view. I have seen in past that Quantep has better accuracy as compared to Opstra. Opstra does a very poor job at providing the accurate data. We have seen many times, but it's the interface that we like, and it helps us identify trades quickly. That's why we use Opstra.
In fact, Ashish, I'd just like to point out an example from Opstra where they've been pretty wrong. If you notice, there's a column called volatility skew. So the volatility skew in Opstra is often calculated on spot, and I do not understand the reason why. Because something like Power Grid, where there was a dividend expectation and the futures were way lower than the spot price. I mean, the vol skew was actually calculating based on the spot prices, which were completely distorting the data. So there you have just one example of how it might not be very accurate, and you need to double check.
Right. And one other thing where they almost go wrong every earning is earning announcement. They don't update earning calendars properly. So that is one thing. So whenever I'm putting earning based trades, it's not just the Opstra that I'm looking at. I also go to BSE site and check whether if there's earning announcement already done or not. So yeah, that's where it lacks. Otherwise, it's good to use. Okay, I think Nikesh, you can ask your question now.
Yeah, my question would be around basically whether the choice when choosing a trade is an illusion when we are doing a delta neutral. Let me elaborate a little bit on this. Suppose this is the start of the month and I have a 50 lakh account size, 50 lakh capital, and choose randomly five stocks with two lots of each and each having 10 lakhs at position limit. So it will be 2x exposure. And I randomly do 15 delta strangle cell. So uh, the question is, if I'm doing it randomly and if I'm doing a choice, see, I'm seeing on the chart, okay, this is the good setup. It looks like a good setup. Does these, is there any difference really in both the things? I hope I'm clear in my question.
Yeah, there are few things which you still need to look at. Doing randomly is all fine, but I would suggest that there are still a few things which you need to look at. So let's say if you are doing a strangle or a straddle in a stock which is showing a continuous one-way move. It's up, let's say 20%, 15% in last 1 month, and then at that point, obviously IVs will be high. But if you decide to take that trade, then it might not be very wise to take trade in such a stock. Secondly, other thing which you need to look at is the break evens that you are getting by putting on a trade, and the credit that you are receiving. So let's say if I have to do it, and if I do a 15-16 delta in Reliance at this point in time, I might not even get 10K at the start of the month, which is very less. So if you are you are already trading with lesser exposure, 2x exposure. And then if you choose to deploy strangles in stocks wherein you are not collecting enough premiums, enough credit, then chances of making decent money reduces.
So Ashish, if I
So
take a sole criteria, okay, I don't do it randomly. I just take a one filter. Okay, these are the five highest stock where I'm getting a good premium. Would it be a good choice rather than looking at the chart? Because chart can mislead a lot of time, and you most of the time you basically mirror what you are thinking on the chart. It's not chart speaking to you; you are speaking to the chart. That's what I think. So, would it be a good idea if I simply make a filter and apply that trade simply based on?
again, I think my answer to that would again be no, because if you just look at the premiums and you filter based on premiums, then you might end up taking stocks which are highly volatile, and there is a reason you are getting very good credit in those stocks. So these are the things which you have to take in consideration collectively, in my opinion. Shubham, do you want to add something to it?
So Nikesh, I get your point, right? Theoretically, and I mean, just purely theoretically, the probability is all there, right? Option prices are factoring in everything, so it might not make a difference whether you choose a portfolio of five delta neutral stocks or whether you just randomly pick stocks.
Mhm.
But at the same time, that's the same thing as saying that if there is a bull market and you had to choose between a portfolio of 10 high beta stocks, you could pick up any five and they would all do well, right? I mean, it's just that following an approach based on IV selection narrows down your trades and it helps you be more mechanical about it. I mean, doing a trade at a IVP of 80 or doing a trade at a IVP of 20, the probabilities are in all likelihood going to be the same. It's just that you're getting more bang for your buck at an IVP of 50
Okay,
plus.
I would like to have luxury of asking one more question.
Yeah,
So,
please go ahead.
what is it which tells you or how you deploy some strategy over some stock? I give an example. I was looking at the Jubilant Food trade. Okay, and that trade for me looked like any other strangle trade. I if I am looking at that chart, I could have taken a strangle, but you guys preferred call ratio spread. So what does it take to you decide on the strategy which you want to apply on that moment? That I want to understand.
Nikesh, you're absolutely right. The payoff is very similar to a skewed triangle, except that there is no risk to the downside. So when we were sharing the Jubilant trade, I wanted to put on some bearish deltas, and I told Ashish the same that the stock has run up a lot, and I did not want to take any downside risk. But as you said rightly, the payoff was very similar to a triangle. Secondly, there is a very huge call skew in Jubilant, which actually makes the spread that we bought, the 3900 spread that we bought cheaper, and the extra naked call that we sold expensive because it was further OTM. So in a way, the trade was working in our favor. It was giving us the benefits of a triangle with no risk to the downside. Plus, we are utilizing the call skew. So these three factors were the reason that we took a sort of a laddered position in Jubilant.
Okay, great.
Yeah, and the payoff might have been same, but there is a slight difference in terms of T plus zero profile for a strangle or for a position which has a long option in it. So this ratio had a long option obviously in it, and that's why the T plus zero profile would not bleed as much as compared to the strangle if the stock were to continue its up move. So that's one more thing. That's a slight difference between the two.
Okay, thanks.
Uh, yeah, okay. I think Anirudh, you can go next.
Yeah, my first question is that like in last June month there was I have a position in Adani Enterprise specifically, and the stock just opened 20% down circuit. So in such scenario, what should one should do?
Book loss.
Okay,
I would say book loss.
okay,
Yeah, when we are in naked short position and a stock opens at 10%, 20%, uh, when I don't know how it opened at 20% because circuit filter should be at 10%.
no, no, yeah, yeah, it opened at 10%, but the call side, the IVs are high before that, before this
right,
news came,
right.
but
Try adjusting your position as long as your par capital. We try to act much prior to that, but whatever max loss per trade limit which you have set for your account, if it is beyond that, then do not try to over adjust the position and just go ahead and book the loss in that one. The only thing that will save you in stock options is your position size. So if you have taken that trade with a 3 lakh margin, the hit that you might get would be much higher as compared to when you have taken that trade for a 2x exposure. So yeah, stick to these rules, and then if your max loss per limit is breached, it's best to get out of the trade. It does help in other things also. You know, it helps in identifying new trades also. It removes your entire focus from that particular trade and lets you think in a better way.
okay, okay.
Yeah,
So
Shubham.
so your answer is that I just in such cases just book a loss and start a new trade.
Right. If your loss is breached, max loss per trade limit is breached, then book the loss.
Okay, okay,
So Anirudh, like my approach would be slightly different, because if the stock did open at 10%, I don't remember, I can't recall exactly, but and it continued to slide down, probably the implied volatilities would be high enough for you to maybe convert your position into a straddle. And if the stock price was within those break evens, I mean quite well within 3 to 4%, I would probably hold on to the trade at least until the IVs drop.
okay,
If the stock continued to slide down, I might buy a put spread, but it's very difficult to sort of speak of it hypothetically, because you need to be in that situation. But when you're trading a stock like Adani, you have to have a far larger capital than I think for me the minimum capital size to trade Adani would be uh, maybe around 60 to 70 lakhs.
oh, okay,
Yeah,
okay.
because the notional value, I look at notional value. So the notional value of Adani, I think at that time was around. I'm
15
not sure,
lakh,
but it was
15 lakh per lot
yeah,
in
yeah. So 15 lakhs per lot, and I generally try to control it within 20% exposure. So
so you are saying that if capital is above 75 lakhs, then only we should.
yes, that's my personal preference. But even if you go higher than that, maybe 30%, even then you need to have at least a 50 lakh account to trade an Adani stock.
Okay, okay, okay,
Unless you're doing it risk defined at a very small loss. Yeah.
okay, okay, okay. I
Yeah,
got it.
I just want to add something. This is one difference between I and Shubham. I like to take losses quickly. Shubham stays on with trades following proper mechanics, adjustment mechanics, and Shubham tries to hold on to both winners as well as losers uh, much longer than me.
Okay. Okay. So that's the goes on like your in personality based traits and adjustments one should do. Hello. Hello.
Yeah, you can say that.